Welcome to the Deep Dive. We're here to take those dense corporate reports and, well, really boil them down to the strategic essence.
That's the plan?
Today, we're jumping into the world of global beverages. We're looking at the Q3 2025 earnings call for the Coca-Cola Company, ticker $2.
Right. And for you, the listener, we've got a specific mission here. We want this to be focused, but, really insightful.
So what's the angle?
We're looking only at the prepared remarks from the chairman and CEO, James Quincy. We really want to pull out his strategic take on the quarter.
Okay.
How he sees the challenges, where the wins were, the path forward. We're intentionally skipping the detailed CFO numbers and the Q&A this time.
Just the CEO's narrative. Makes sense for clarity.
Exactly. Pure focus on the overarching business strategy.
And that strategy needs to be solid because that external environment, it's not exactly smooth sailing, is it?
No, definitely not.
Quincy called it dynamic, but
Yeah.
let's face it, that's usually corporate speak for, well, tricky.
Challenging, at least.
So, okay, let's unpack this then. How does a giant like Coke manage to hit expectations in Q3 2025 with all this global turbulence?
Well, it starts, I think, with just acknowledging what's happening. The CEO, he didn't really sugarcoat the operating landscape. He did say, a lot of consumers globally are in overall good shape, but he was also specific about where the pressure points are.
Okay, so not everyone's feeling okay.
Right. Certain segments, he said, are under, immense economic pressure.
That distinction feels important. It means they can't just paint the whole world with one brush. They need targeted approaches.
Precisely. They're dealing with very localized pockets of economic difficulty.
And did he talk about why? What's causing this complexity?
Yeah, he broke it down into sort of two types of factors. First, you've got the transitory stuff, like weird weather patterns hitting consumption for a bit.
Things that pass quickly.
Exactly. But then there are the longer-lasting, maybe more structural things.
Talk about it.
Things like the cumulative hit from inflation that's just worn down purchasing power over time, shaky trade dynamics between countries, and, of course, the geopolitical scene, which is always shifting and impacting supply chains, market access.
A lot to juggle.
Yeah.
So against that backdrop, this all-weather strategy they talk about, how does that actually work on the ground? Sounds good on paper, but...
It's basically their playbook for adapting. The core idea is no matter what the weather's doing outside, metaphorically speaking, they have levers they can pull.
Okay.
So in this kind of high inflation world, the all-weather strategy means, and this is his phrase, sharper execution and investments.
Sharper execution.
It means leaning into things like affordable single-serve packs, getting smarter about different sales channels. If people aren't buying big 2-liter bottles at the supermarket.
They shift focus to maybe corner stores, smaller, immediate consumption packs, higher margin stuff.
Exactly that. Adjusting the mix, being nimble.
So they're trying to adjust the sales faster than the competition.
That's the goal. And look, they confirm that even with this really complex environment, the system is delivering. They're on track, they said, to hit their guidance for 2025. Both top line and bottom line.
Sticking to guidance despite the headwinds is definitely a confidence signal.
It absolutely is, and it feeds into their confidence about hitting those longer-term financial goals, too.
Okay, that confidence, it must stem from the actual Q3 numbers. This is where it gets really interesting, right? The results that show they're managing.
Yes. And the CEO noted it wasn't exactly a straight line through the quarter. July and August apparently started slow. But September finished stronger. And that allowed them to deliver overall volume growth for Q3.
That pickup in September is key then. Shows momentum.
It does. And maybe more importantly, organic revenue growth was still at the high end of their long-term target range.
Which tells you they're managing that balance between price increases and volume sold. They're getting price without killing demand.
Seems like it. They're finding that sweet spot.
And efficiency, too. They mentioned something about margins.
Right. Ongoing efficiency and effectiveness initiatives. These apparently drove expansion in their comparable operating margin.
Okay, let's pause there. Margin expansion. Why is that such a big deal for a company like Coke, especially when inflation has been hitting costs?
It's absolutely vital. Operating margin expansion, it basically means you're making more profit from each dollar sales after covering your costs, ingredients, packaging, running the business.
Right.
So when inflation is pushing up the cost of everything, like sugar, aluminum cans, shipping, if you can still grow that margin. It suggests you're doing a great job controlling costs, or you have strong pricing power, or maybe you're selling more high-margin products.
It signals really strong operational health, managing that huge, complex supply chain effectively.
Exactly. And then you get to the headline number, the core metric that really speaks to that operational strength. Comparable earnings per share grew 6%.
6% growth. Solid.
Solid, yes, but you have to look closer. Because they delivered that 6% EPS growth while fighting against a massive 6% currency headwind.
Whoa, wait, a 6% currency hit?
Yeah, a significant drag. Essentially, the strong dollar wiped out a huge chunk of the growth they generated overseas when they translated those earnings back.
So if currency took away 6 points, and they still ended up with 6% growth,
Yeah.
doesn't that imply the underlying growth, like constant currency growth, was maybe double that, around 12%?
That's the math, and that's the operational achievement. It's partly smart currency hedging, sure, but mostly it's about fundamental strength in the local markets. Pricing power, productivity gains.
Being strong enough operationally to basically offset that massive currency swing.
It shows remarkable control, yeah. Driving improvements faster than the currency markets can erode them.
And on top of that, they're gaining market share. Consistently.
Yes, the CEO pointed out they're in a vibrant and resilient industry with plenty of room to grow.
And they seem to be grabbing that room.
They are. They gained overall value share for the 18th consecutive quarter. Just think about that.
18 quarters, that's 4.5 years straight.
Incredible consistency. And it wasn't just in one strong market.
Yeah.
He said they held or gained value share across every single one of their geographic operating segments. Africa, Asia, North America, Europe. The strategy's working everywhere, locally executed.
That's pretty impressive breadth, which speaks to, I guess, the core strengths he highlighted, starting with the brand portfolio.
Exactly. He used the term unparalleled portfolio power.
Unparalleled, that's a big claim. What backs that up? What makes it unparalleled?
It's the sheer scale and depth. He mentioned they have $30 billion brands in their stable. 30.
Okay, $30 billion brands is a lot.
It is. And he put it in context.
Yeah.
He estimated that collection represents about a quarter of all the billion-dollar brands in the entire beverage industry.
Wow.
And maybe more tellingly, it's approximately double our nearest competitor.
Double the next guy. That's not just bragging rights. That's a structural advantage, isn't it? What kind of leverage does that scale give them?
Oh, immense leverage. Think about distribution clout with retailers, negotiation power, and crucially, how they allocate capital.
Yeah.
Well, they have so many proven winners. If one area slows down, say, sparkling drinks in Western Europe are sluggish?
They can push harder on sports drinks somewhere else, or water brands in Asia.
Precisely. They can shift resources quickly. That diversification makes their overall performance much more stable, and it helps them command incredible shelf space.
Okay, so you have the brands, but you've got to keep them fresh, keep them relevant. Let's talk marketing. He mentioned a transformation there.
Yeah, the focus seems to be shifting towards connecting through deep cultural relevance, often using digital tools. He gave the Fanta Halloween campaign as a specific example.
Ah, yes, the one with Universal Pictures and Blumhouse, the horror movie guys.
That's the one. And it wasn't small scale, activated in about 50 markets around the world.
50 markets, wow.
And it was more than just sticking a logo on something. It involved, putting iconic horror characters on the actual cans and bottles, limited time spooky flavors.
Creating some buzz, some urgency.
Right. And then immersive experiences at retail, plus digital stuff like augmented reality filters, games, making it interactive.
But does that kind of big splashy campaign actually build long-term share?
Mm-hmm.
Or is it just a short-term boost for the quarter's numbers?
That's always the question, isn't it? But I think the goal here is less about just the Q3 volume bump and more about keeping the brand like Fanta top of mind, especially with younger consumers who maybe don't respond to old school ads.
Keeping it culturally relevant.
Exactly. Embedding the brand in these pop culture moments like Halloween horror helps keep it vibrant, justifies maybe a bit of a premium price compared to store brands, and sort of future-proofs it.
Makes sense. Okay, moving from marketing buzz to actual new products.
Right.
Innovation. The CEO said it's getting bigger and bolder. What examples did he give?
It seems quite localized, actually, targeting specific gaps or trends in different places, like Sprite plus tea in North America, tapping into that hybrid refreshment trend, then getting more into ready-to-drink cocktails with Bacardi mixed with Coca-Cola in Mexico and Europe.
Interesting. Alcohol partnerships.
And even hyperlocal stuff, like a Powerade Springboks edition in South Africa, tailored for athletes there.
So it's not one giant global launch, but lots of smaller targeted bets adding up.
Seems that way. And he stressed, this isn't just R&D talk. This innovation push contributed strongly to revenue growth in the first 3 quarters of the year.
So it's working.
Mm-hmm.
But innovation, portfolio power, it all needs execution, right? Which brings us to the system itself, the bottling network.
Correct. And they're strengthening that system by finishing up this huge decade-long refranchising effort. It's almost complete.
This refranchising.
Yeah.
It's arguably the biggest strategic pivot they've made in ages. Moving away from actually owning the bottling plants and trucks.
Yeah.
Why is finishing that now so key for growth?
Because it fundamentally changes what Coca-Cola is.
Yeah.
For years, they were both a brand company and a massive manufacturing and logistics company, heavy assets.
Right.
By selling those assets off to dedicated expert bottling partners, the refranchising Coke becomes much more asset-light. They focus purely on building the brands.
So it unlocks growth by letting them concentrate 100% on marketing, R&D, innovation, while the local bottlers handle the capital-heavy stuff.
That's the idea. The local experts handle the execution. And the CEO mentioned 2 big recent steps signaling they're really in the final stretch.
What were those last big pieces falling into place?
First, back in July, they sold a 40% stake in their company-owned bottler in India to the Jubilant Bharta Group. India is a huge, complex, fast-growing market, so getting a strong local partner there was key.
Okay, India done. What else?
Second, Coca-Cola Hellenic, one of their biggest independent bottlers, announced it intends to buy a controlling stake in Coca-Cola Beverages Africa. That deal is expected to close next year, assuming regulators approve.
Coca-Cola Beverages Africa. That's one of the biggest bottling territories anywhere, right? So that closing next year would pretty much wrap up the whole global refranchising.
It would basically cement that asset-light model globally. And the rationale, as the CEO put it, is that this global franchise system is a strategic differentiator and really very difficult to replicate.
Hard for competitors to copy that structure.
Right. The system's built for agility now. Coke designs the brands and marketing, and this network of strong, focused local partners executes it precisely, allows them to adapt faster, reinvest capital more strategically.
Yeah, that really paints a clear picture of the strategic vision.
Yeah.
So wrapping up, the CEO sounded confident, ready for challenges, hitting the 2025 goals.
Definitely. Expressed clear confidence, said they're ready for whatever comes at us, basically. On track for the guidance, committed to long-term value. The whole message was one of resilient execution.
Underpinned by that unique structure.
Absolutely. And that structure, the completed franchise model, really is the core of it. Which brings us to a final provocative thought for you, the listener, to consider.
Okay, let's hear it.
With this decade-long refranchising journey essentially complete, putting all those bottling assets in the hands of partners, what does that really mean for Coke's ability to pour even more capital and focus purely into being a global brand builder instead of also being a logistics operator? If they don't need to fund quite as many factories and warehouses anymore, where does that potentially massive amount of capital go, and how could that reshape their competitive edge over the next decade?
That question of future capital allocation. Where does the money go now? And the sheer scale of brand building they might be able to unleash, that is huge.
Yeah.
Definitely something to chew on as we watch Coke move into 2026, fully asset-light.
Indeed.
All right, that's all the time we have for this deep dive. We hope you feel well-informed and ready to tackle whatever comes next.